The Fund Shack Private Capital podcast is produced by Linear B Group, the leader in content, media and podcasting services to the investment industry. Today my guest on the Fund Shack podcast is Henry Freeman, a well-known commentator on both public and private investment markets. Henry's been an investment manager on the buy side, an institutional stockbroker, a fintech entrepreneur, a crowdfunder entrepreneur, a charity entrepreneur and an investment trust board member. He's also the founder of a new service launching soon called the Fund Society, which we'll talk about. But we begin by looking at the opportunities and pitfalls of bringing private equity to the mass market. And I'm delighted to have him with us today, and we're going to have a great conversation.
Thank you very much, Ross. Good to be with you.
What's your interest in the private markets? Because you're really, for me, you're kind of coming from the public market side of things. You're very familiar with that, and yet always you've had an alternative investment bent.
Yeah, well, I mean, I've always been really interested in private equity, to be honest. I guess a bit of a nerd through university and looking at the history of companies and how they evolve and, you know, the different stages they go through, whether it be the venture side. I started out as an investment manager, so I joined Lloyds Private Bank initially and was a portfolio manager there and at Hill Samuel, which was part of the Lloyds Group. And then I moved on to a multi-manager firm and I established a new fund which I could really put my interest in private equity to the fore. I was established it was an open-ended fund, but it would invest in private equity plays that were listed on stock exchanges around the world. So
when was this?
This was, I think we launched it in 2004, 2005.
So that's quite early for a public market private equity play.
Absolutely, yeah. So it would invest in, you know, the London listed closed end investment trusts, you know, 3i or HG Capital or, you know, any Oakley
Had
Capital.
Blackstone listed by that point? It was about that.
Blackstone was just going through. So we could also invest in asset managers, and Blackstone was clearly one. KKR had listed a fund on the Euronext exchange, and Apollo had done the same. So the big boys were also looking at the listed world and the listed space, and so that's really where I started to get a real interest for private equity.
But can I just ask why?
Yeah.
Why did you decide to set up an open-ended fund for alternatives? It was not an obvious thing to do, particularly then.
You're right. I think private equity was starting to be, or private assets was starting to be a little bit more talked about. The group that I was working with, Forsyth Partners, they ran alternative hedge fund. They had quite a big hedge fund business. I think we had a bit of interest, and AIG was actually our cornerstone, was my cornerstone investor in that fund. And I think they needed to have an exposure to private equity, but it needed to be semi-liquid. And, you know, this is where we find ourselves today with a lot of the talk about how to structure these things, you know, the new ELTAFs and LTIFs. And
why would an insurer need a semi-liquid vehicle?
To be honest, I couldn't tell you that. You'd probably have to ask them. Yeah, sure. So they came on board and we raised money from other investors as well went into the fund. And because we were investing in stock exchange listed companies, a lot of them big sized, we could get the liquidity. You know, we weren't promising daily liquidity because listed investment company stocks are not necessarily the most liquid stocks on the market, but you can manage it.
Yeah, it's a simple way of getting a bit of liquidity in, is just to kind of make a little bit of a mash of private and public assets. Right. Okay. So
I really enjoyed sort of putting that together and running it, and we ran it for 3 or 4 years. Unfortunately, in 2008, AIG had a few other issues, and
I heard about them.
Needed to basically get their hands on anything that was liquid, and so we actually took that opportunity to wind the fund down, because looking down the barrel of the gun in the start of 2008, things didn't look like they were going to be very pretty, and indeed they weren't, and things got a lot worse. So I think we did right by our investors, and actually I was obviously a client of quite a few of the institutional stockbroking houses in the city, and I went over to one of those. It was great fun. Liberum had just started itself really in 2007, so I was an early client. And then to go in and help them build up the investment company's desk was fantastic. And I brought with me one of my colleagues from Forsyth to help me on the research side, and we built out a great franchise, and it was great fun. Coming out of 2009 through to 2012, coming out of the great financial crisis, it was a fantastic time for picking absolutely blinding value in the market. And we're sort of seeing those sort of discounts in listed private equity now.
Do any stick in your mind from that period?
Yeah, I mean, you could be buying cracking company. You could be buying Oakley Capital on sort of a 40% discount. Actually, it's probably still it's around 25-30% now. So there's still huge value. You could be buying any number of really, really high quality managers. And then if you looked at some of the other private asset classes or alternatives in that space, you could be getting double, if not triple discounts, because you'd be investing at the share price, which would be at a discount to the net asset value. And then if you looked across to sort of the CLOs, there was a couple of CLO funds at the time, outstanding value, triple discounts, because the CLOs themselves were marked down massively simply because no one wanted to touch them. You could invest in Apollo's Euronext fund at, I think it was pretty much an 80 or 90% discount. Some clients did incredibly well out of those trades. It
was fill your boots time, right?
It really was. It really was.
But that was the old days when things were, relatively opaque to the wider world. And everyone knows about private equity in the broader markets now.
Yeah, they
couldn't happen again, could it?
Well, I mean, you look at that same sector now, and actually, you've had discounts did narrow quite considerably. 3i went back to a premium. HG Capital went to a premium. Really good quality firms, naturally where they should be trading. But through COVID and out the other side, obviously inflation going up, interest rates going up, it meant again, there was a bit of a flight out of risk assets and the listed PE, listed fund sector generally. You started seeing these discounts widen out again, and there's still, huge value. I think there's some cracking value around. I've been picking up. It's quite nice not being employed by an investment bank now or an investment manager, because it means I can just go straight in. I don't need to fill in forms, etc. So I now live in Guernsey after 20 years in London on the investment management and investment banking side, to really go non-exec director and take on a few other positions with managers, with funds, and help them with whatever challenges they've got. And so now in Guernsey, I stay involved with private equity. I sit on the board of Guernsey's sort of sovereign wealth fund, the State's Investment Board, and we've actually been sort of restructuring the funds, and private assets are a key element that we've been making sure that we are invested in properly. And so, again, to be able to see what's going on in the world of VC, what's going on in buyout land, and it's a really interesting place to be. Guernsey itself, I'm a massive advocate for Guernsey. It's been great fun sort of moving there and building a new life there. And it's in itself, it's a huge hub for private equity on the operations side. It's a go-to place for administration, for private equity fund administration. A lot of the bigger houses still have a presence there, and just how Guernsey works with first-time managers as well. The different structures, the different sort of flavors of funds that and entities that you're able to establish. It's got everyone you need to know in a very short a very small space. Literally, you can get everything set up for a fund launch in a very short amount of time. It's it really is quite a fresh approach compared to the bureaucracy that you can go through in other jurisdictions. So it's
what underlies that lack of bureaucracy? Is it the regulatory environment,
I mean,
or is it more a cultural thing?
It's actually very well and highly regulated. I think it's people driven. It's a small place, so it's a small island, and so everyone knows each other. It is very, as I say, it's very easy to connect with whoever you need to see. There's nowhere else you can really do that. So I give up my time and sit on the GIFA, the Guernsey Investment and Funds Association, sort of the trade body for industry as well, and very proud and pleased to be working with Guernsey Finance, which is the promotional agency for Guernsey. Yeah.
And so does that almost bring us up to date?
I guess the one thing the other thing, I've always got a little bit of an entrepreneurial I've always got a few ideas bubbling, and one of the ideas that I am currently working on, which we're launching very shortly, is the Fund Society. And actually, again, it's all about connecting dots. It's an online hub for investment professionals. We're doing a lot with private wealth markets as well, and it's really enabling institutions, fund managers, to get their thought leadership, intelligence-based content that is often, very relevant for much longer periods of time. We help them to get a longer life out of that sort of content, and we are connecting investment professionals, no matter sort of where they sit, so that they've got up-to-date industry news, as well as a brief bit of market news. We're certainly not trying to replicate what Bloomberg does or the FT, and indeed we're working with news organisations, sources to bring a curated news aggregator. So again, high-quality investment writing together with proper intelligence-based content, and so we're launching that very shortly.
You covered so much. I want to go back to the start and talk about some themes that have come out of your very varied career. And so one of the really obvious themes, and it's at the front of mind of so much of my audience, the democratization of private equity, the retailization, both of which are very unsatisfactory terms, because it's neither of those things really. It's more just increasing the access to private equity returns for ever smaller investors. It's more like a fractionalization of private equity, which is what I might call it. And so this is also, it's like the holy grail of private equity investor relations. It's not really investor relations either, really. It's more like investor acquisition of a whole new market. And if it can be done well, then it changes everything. And there's a whole new world of growth ahead.
I do really think the next big push, the next big influx of capital into private assets is going to come from private wealth. There is absolutely every reason why private wealth should be able to access and invest in private markets. The issue that they've all had to date is one of liquidity, because they manage portfolios on behalf of their clients. That's where I came from. I was initially started out at Lloyd's and Hill Samuel as a private client investment manager. So I know that market very well, and I know the stresses that the managers need to bear, and clients may well want to cash out some of their portfolios so that they can help one of their children buy get a deposit or whatever it might be, get on the housing ladder, or there's always going to be calls for the capital, and you don't know necessarily when it's going to come in. And that's been the issue for private client investment managers to date, is they can't commit, and that's what these GPLP funds are. It's a commitment. You commit your capital and it gets drawn as and when it's needed by the PE firm to invest.
This is the real bugbear. This is the thing that really everyone's trying to structure their way around. But to some degree, I think it's zero sum. And the reason for that is that my view of the success of private equity is that it is all pretty much 100% about commitment. And anything you do to water that down will water down the proposition as a whole. And so you have first-hand experience, so I'm not denying that you're under constant pressure for capital calls. But we kind of assume that people want like immediacy, like everyone's got ADHD. Our society can't stop, fiddling with things and buying and selling. But if you look at people's lives, that's not actually how they behave. So people get married. And in fact, the more money they have, the more likely it is they get married. They deliberately remove their life options because they know that kind of commitment is good for the long term. And yet we seem to make this assumption that they're incapable of committing when it comes to their finances, or even just part of their finances. And I think that might be, excuse me, looking down the wrong end of the telescope. The commitment element of private equity isn't a bug, it's a feature, it's a selling point.
Yeah.
And I think if we could just reframe private equity and stop talking about private, maybe even equity, and talking about commitment as a selling point, then maybe a lot of these structural issues just fall away. It's
a really well enunciated sort of overview of it. I that really does chime through. I think on that point, I do think, yes, you need to have I think private wealth, private managers, they would be willing to commit, and the underlying clients are willing to commit. And that's part of why, actually, there is an increasing interest in private wealth investing in private assets. But they just need something that will enable them, if worst comes to worst, or they absolutely have to take their money out, they need to have some sort of mechanism. I really think the opportunity is with current structures, whether it's almost tokenizing the documentation so that it is a straightforward process to transfer one LP interest to another, that actually effectively would be held in nominee by the private client investment manager or the private bank.
Yeah, the lawyers won't like that.
I talked to quite a few lawyers, obviously, in Guernsey, and they are supportive of some of this. And I think it will happen. This is absolutely the way forward, I think.
But aside from the administrative challenge, there's the fundamental mismatch.
Yeah.
Time horizon mismatch.
So the time horizon mismatch, this is where the concept for ELTIFs and LTAFs, the open-endization of private equity. I mean, the FCA and the Treasury have been quite supportive of LTAFs because they want to see, pension schemes DC pension schemes being able to invest more readily and get exposure, allocate to private assets. Part of that has got to be because you get more investment into infrastructure. It takes a bit of a weight off government to spend on infrastructure if you've got private capital coming. So I absolutely see benefits of it, but the structure of the LTAF being open-ended, I just feel it's not the best structure when we actually already have closed-end fund structures, whether they're the closed-end GPLP with a more fluid administrative secondary market for them, or indeed, the London-listed private equity investment trusts.
And similar across the continent, investment companies.
The issue is, liquidity in that market and discounts, and that has turned, I think, quite a few managers off. And I think, to be honest, there's a lot of financial advisors or DC pension scheme managers that don't, because they only play in the open-ended fund world, they they're not so aware of the listed fund world, the closed-end listed fund world.
That seems kind of crazy to me, because we're going to all of these ends to ensure that, let's say, a defined contribution scheme can get access to private equity style returns. They already can, but they're just not familiar with it. And so we're going to create a suboptimal vehicle that has real risk, that has presumably huge cash drag, which defeats the purpose in the...
So we haven't gone into the why, in my opinion, the open end, the LTAF, is suboptimal, but it's exactly that. You've got a liquidity mismatch. So, these vehicles will be offering, whether it's quarterly or 6 monthly or even annual redemptions. I mean, it's fine, but a manager still has to sell assets if they get a lot of redemptions at the same time. Now, I certainly don't think the groups that are interested in this space and are setting funds up at the moment, I've got no worries or qualms about some of those names. They are all good names that understand the issues as well. It's when they become more of a retail product and they become marketed directly to retail, small retail, who won't necessarily, they'll be sold, as you say, investment, private equity style returns. Well, what is a private equity style return? The IRRs, which private equity market themselves on at the moment, quite rightly, are based on when capital is called and the investment period that it's held for, and it gets sold. So you're not getting the cash drag. And with an open-ended fund, you put all of your cash in straight away. That's fine if it's fully invested. But even then, I think the LTAF is required to have a cash buffer. So, 10, 15, 20% needs to be in cash or more cash equivalents, liquid equivalents.
So this is the opposite.
Immediately you're getting diluted returns.
This is the opposite of what an institution would do. They'd overcommit in order to hit their targets.
Absolutely.
Here, it's a deliberate strategy of undercommitting.
Exactly. And then the other side is, as I say, if managers are being hit by redemptions, yes, again, they have the ability to gate. So up to 5% of the fund can be redeemed at, one redemption cycle. So you'll only get a certain amount of your cash back. So again, there's a bit of uncertainty for retail if actually they are wanting liquidity. What it also does is, ultimately the manager will need to sell assets. If you're in a difficult market condition, take the last couple of years, you're going to have to be selling assets which are the most marketable, which probably the ones that you really want to hang on to rather than sell, which ultimately means that if you get hit by redemptions and, over a 2 or 3 year period, however long it is, and a bunch of investors leave, but your loyal investors are left with a bit of a rump portfolio.
Yeah.
Because the managers have had to sell down.
Well, this is what happened to Woodford, really, isn't it?
Yeah.
To some degree it is.
Absolutely. It is. It's
for our international listeners, Neil Woodford was an active fund manager with an open-ended fund, celebrity really, who started investing in private companies and quite small kind of tech ones as well, and ran into this mismatch problem. And it was a big... And this is the real problem, I think. It's like you say, the names that are looking at it now, their quality, but as soon as you get a kind of a government-endorsed structure like this that can be taken down to the lowest common denominator, it only takes one fund to hit the headlines for the entire industry and structure to be discredited.
That's my fear. That is my fear. I certainly don't think, as I say, the groups, the managers that are moving in, or early stage moving into these structures at the moment, I'm not too worried about. It's when it becomes more of a mass market opportunity, which generally happens after there's been success, and unfortunately the little guys that come to the party late when all the big guys are leaving,
Yeah.
they're the ones that get hurt. And that's where I see potential for, mis-selling scandals, because if they're being sold private equity style returns, what is a private equity style return?
Yeah. And so on the investment company side, to me, this seems like the perfect and most logical solution to this problem. I mentioned that to Jim Strang, who's, I think, currently the chairman of HG Capital Trust. So he's a fan of them. But he said the problem, and this is not to do his point justice, but I'm not as smart as him, so I'm just going to have to go with it. I think he said the problem with that structure is that it's just not as scalable. You can't scale as quickly as you can with like an open-ended vehicle. And I'm sure that's true, but it's like they're not as immediately scalable. But over time, there is no upper limit to, let's say, how many investment trusts you could launch. I mean, when was the last listed private equity investment trust IPO? I mean, it's not like we're inundated with them. And so if pension fund trustees went for this structure, there is really no upper limit to how many you could have, is there?
No, you're right. A share, a stock is only as liquid as, it's a market. So you need buyers and sellers. And if there's more buyers than there are sellers, the price goes up, obviously. And if there's more sellers, the price goes down. And that price is different from the net asset value, the true worth of the portfolio. And so that's...
But again, I would say that is a feature, not a bug. The fact that it can disconnect from its effectively book value, that's a great thing. And it's something that analysts fixate on. But for me as a shareholder, as long as the share price is going up, I don't care where it sits. In fact, it gives me comfort that it trades at a discount. This is not a problem.
The issue is liquidity and the depth of the markets.
But liquidity is just a function of popularity.
Well, you're right.
It's a chicken or egg problem, isn't it?
You're absolutely right. Harbourvest Global Private Equity Fund, FTSE 250. It's a big multi-billion-dollar fund, but it doesn't trade that much relative to its size. It would be the perfect vehicle for a lot of these sort of DC pension schemes to come in and out of. But again, I think because the current volumes aren't...
Yeah, no one wants to be first.
They don't want to be first. They don't want to get caught. And we're trading at 30-40% discounts now, as we were sort of, getting on for 10 years ago,
crazy,
12 years ago.
Where else could you pick up that kind of discount?
Absolutely.
It's these structural issues. I kind of feel if everyone just did their job properly and with a backbone, then a lot of this stuff would go away.
It's interesting. So I was at a Kirkland and Ellis private equity conference recently, and they had the secondaries teams from Collar Capital and Harbourvest and Lexington, the three big players in LP secondary markets. And I did talk to them about, generally the discounts that they're buying LP stakes up for is at sort of 8-10%, 12% discounts to net assets. And I'm saying, God, why aren't you looking at the listed space? And they actually, did a few years ago. So Collar Capital bought out, I think it was SVG, and Harbourvest bought out another London listed, Conversus Capital. So, but they want to take pretty much the whole thing. They also don't want to, and probably quite rightly, they don't want to ruffle feathers and be too activist, or it's a small industry and they don't want to put noses out of joint, and they want to do things as a solution to investors. Again, to a certain extent, they're running and raising huge funds. I mean, I think Lexington's current secondaries fund it's huge. It's many billions.
Yeah.
And so actually, to invest in take a small stake in a couple of $1 billion fund.
You've got to take the market as you find it, don't you?
And that's one of the larger ones.
Yeah.
Obviously you've got much smaller ones down the scale, but there are absolutely blinding pockets of value. So we've got the structures, whether it's GPLP with a better secondary market mechanism, and we've got closed end funds which you could put more structured exits, and maybe that would help to close discounts, and you simply raise a new fund when it comes time. So I just feel the open-ended vehicles which are increasingly coming to market, I'm wary of because of the liquidity mismatch, because of the potential for mis-selling, and the type of returns that you can actually potentially get.
Changing tack completely, I want to talk about the Fund Society, which it just occurs to me is quite a similar name to Fund Shack, but a bit more serious.
I don't know. I mean, actually, the Fund Society, so online hub for investment professionals, delivering intelligence-based content, thought leadership, but with a witty, pithy edge, and news aggregation. So I think that's also important. It's where you can come for your industry download, what's going on in industry, what's going on in markets. We're not, as I say, we're not going to get into the weeds of everything. And
it's more thematic.
It's much more thematic, sort of bigger picture.
What's the persona of a user?
Investment professionals, I think we're probably going to be more focused initially on private wealth markets, fund buyers, obviously, and really able to connect to fund managers across asset classes. We've talked a lot about private wealth coming into private assets, and I see one of our raison d'etre, certainly in the nearer term, is to really bring investment advisors, investment managers up to speed with what private equity or private asset investing is, how to do it properly, and that's the thought leadership stuff. That's the intelligence base, and that's why we want to work with the great houses, private equity houses, private credit houses, to really educate and help get the message across to their potential clients.
And so what's the model? Can you read it for free, but you have to pay to
free membership for users. The model is a subscription for our corporate partners that we are helping on the thought leadership intelligence-based content delivery. And we're using AI and large language models to really so that we can ensure relevant thought leadership material comes up when it is newsworthy, when something else is trending in the news or markets, or something's just happened over here. Something that was written 3 months ago on use of mezzanine debt, or use of private credit markets, sort of, or how does the VC world look in comparison to the buyout market? What's going on? We can re-elevate those stories depending on what's topical and actually happening today in the news. Something.
Yes, and you can search for it as well, presumably.
Exactly, very searchable.
Yeah. And so it's curated content, and it's self-selected good content, because if you're paying for a subscription, you only want to send in your best stuff. Is that right?
Absolutely. So it's up to our corporate partners. We can help them pick and choose which bits of content and there's different tiers as well. So if you've got a daily note that actually you really want to get out in front of people, and it's saying what's going on, it's a very short. Daily notes generally tend to be quite short and very easily readable in 5 minutes. So we've got a service for that, and then a separate subscription. If you're just putting out one piece a week, or a couple of pieces a month. We also want to be democratic, actually, for smaller boutiques, newer firms that maybe don't have the marketing budgets that some of the larger houses have. So we've devised a subscription level, partner level for those houses as well. So we really want to, that was one of the things that I did. I used to sit on the ratings committee for Forsyth ABSR, and one of the things that was great was it was very democratic. So we'd have the boutiques, boutique investment managers that had cracking investment products, and we'd be able to put them on exactly the same level as the big guys. And, I personally think that's really important to keep entrepreneurial spirit
Yeah, there's no monopoly on insight.
Exactly.
And it's great if you can level the playing field somehow.
Absolutely.
So my company, Linear B Group, we're a content marketing agency. We work with a lot of firms in this area on producing content like this. And one of the frustrating things is that, Bill Gates famously said, content is king. But I don't believe that's true. I think content is everything, but distribution is king. And you can spend a lot of time and effort on a great thought piece, and within 10 minutes, it gets buried. Yeah. And so we spend most of our time actually on advising on distribution. And this, for me, sounds like a very good way of, curating that and making sure people can find it when they want it.
I mean, that actually is exactly why we've set it up, because LinkedIn and social media is fantastic for getting stuff out there and, being in the news feeds. But as you say, these high quality thought leadership pieces or intelligence-based content pieces, educational pieces, really, they are all important, but they go out on LinkedIn and, as you say, 10 minutes later, if you're not logged on your LinkedIn feed when it goes out, you've missed it. And so I think houses have a really tough time of it, because these pieces, and actually I think there's a stat that I refer to, 90% of investment houses use thought leadership pieces. A similar statistic of in the institutional world of institutional fund managers, pension fund managers, also say they would not invest without sort of the depth of intelligence-based content. That's how they find and seek out good managers to work with as well. And so it's a really important part of the investment process. But we're starting to lose it because social media is just so noisy. And so what we want to do, what we're doing with the Fund Society, is we're breaking that down, and we're basically siloing out the longer term thought leadership, intelligence-based stuff, which has a longer life. And we're bringing it back to the top when it's newsworthy. It's always searchable, as you say, and it gets a better return on investment, to be honest, for the fund managers, for the house, but it also ensures that our members are able to easily find the intelligent content that they need to help them be better managers themselves and better investors themselves. So that's really what it's about. And, we've got some interesting stuff going on there as well. So podcasts, and, this is one of the key media now of how people are getting their thought leadership, their intelligence-based stuff. We use AI, large language models, to take transcripts of podcasts. We tag them just like the written stuff, and then we're able to bring the podcast up. Because again, where do you start with podcasts?
Podcasts are notoriously difficult to find. The search function on, say, Apple, it's dreadful. And so again, if you're not there when it pops into your feed, it's gone. So
that's it. It's
when are you launching?
So we're launching Q2 this year, 2024.
And where can people find it?
Thefundsociety.com.
That'll Google that.
Thefundsociety.com.
Yeah. I wonder if there's another phase to it, which is of interest as readers from the buy side. So in private equity firms, for example, you've got deal originators, and they're all looking for an angle. And, I was speaking to a deal originator the other day, and he says he reads The Economist from cover to cover each week. He's probably the only one in his little firm that does that. But it's like he's looking for an angle and a theme in the wider world that provides some inspiration. And you've got all these investment banks with huge research teams putting out interesting stuff to their clients, and then it goes out of the inbox. And so actually I could see that it's potentially interest to both sides.
So absolutely, one of the sort of add-ons you get as a partner subscriber working with institutions is our analytics that we're able to provide to them based on what members are looking at. what they're doing, what they're interested in. And I think at the moment it is much more read only initially at launch, but our intention is to make it more of a community so that, well, users will be able to comment and share, members, I should say, will be able to comment and share, stories and content with their friends, etc. And we're using LinkedIn actually very complementarily. So our members will be able to just register one click with their LinkedIn profile. So things are, it's going to be seamless. But yeah, I think there's a huge opportunity for ensuring that how investment houses are able to understand actually what investors are looking for. So it's very definitely a community that we want to build.
Great. Well, I look forward to logging on when you go live and checking it all out. Best of luck with it, Henry.
Brilliant.
And thanks so much for coming on the show.
Thank you so much.
You've been listening to the Fund Shack podcast. It's the private capital channel for alternative investment professionals. This podcast was designed and produced by Linear B Group, a leading content marketing agency focused on financial and professional services. Thanks for listening.